The Christmas holidays are a great time to review your investments and make sure they're well placed for the year ahead. To help you do this, I'm going to look at each of the main world markets and assign them a special Santa rating to show their prospects for 2014. Markets with poor prospects are going to get a single skinny Santa. Markets that are well placed but look a bit expensive after the rally in 2013 will get 2 Santas, and markets that are well placed and look better value will get 3 fat Santas. The aim of all of this is to rebalance your investments to prevent them being dominated by markets that have done well but may slow down. Like our traditional image of St. Nick, many investors, ISAs and pensions have grown fat and jolly during 2013. It makes sense to spread some of these gains around to leaner, better value parts that might start to move ahead in 2014. These are happy times for investors. For the first time since the financial crisis, a synchronised recovery has taken hold around the world. In 2013, we saw economic growth in the UK, US, Europe, Japan, while China stabilised after a slowdown. There are 2 caveats, however. In 2014, we really need to see companies start to deliver profit increases that will justify the stock market surge we've seen and provide support for further gains. Secondly, a lot is riding on the US and how it handles the tricky process of withdrawing its policy of injecting billions of dollars into the economy. If it gets it wrong, things could get messy. Let's start with the US. It gets a double Santa rating. Economic growth is expected to accelerate to 2.6% in 2014 as government spending cuts are lifted. America's shale, oil and gas energy boom has transformed the country's prospects and given its companies a huge competitive advantage. But the stock market is a bit expensive. The S&P 500 index is valued at around 15 times the earnings US companies are expected to report this year. That compares with an average price to earnings multiple of 14 over the past 10 years. That doesn't mean a bubble's about to burst and share prices crash. It just means returns are unlikely to be as good as 2013. The main risk is that interest rates shoot up as the Federal Reserve cuts back on the amount of money it's printing. Let's look at the UK. It gets a triple Santa rating. There are similarities to the US. Forecasters expect the UK economy to match America's in 2014. A buoyant housing market is playing a big part in the recovery, notwithstanding public spending cuts. Bank of England Governor Mark Carney is desperate to keep interest rates low to prevent a debt crisis. What's different is that the UK stock market is fair value with a price to earnings rating of 12.5, which is slightly higher than its 10-year average. I'm giving the UK 3 Santas because it's our home market and you have to put your money somewhere. Europe also gets 3 Santas, but for different reasons. The Eurozone came out of recession in 2013 but remains dogged by sluggish growth, low inflation, high unemployment and the fear of a rerun of the banking crisis. So why invest there? Because the slow recovery means Europe's stock markets trade well below those of the US and are comparatively good value. It's a double Santa for Japan as well. Prime Minister Abe has printed money at an even faster rate than the US. Supporters say he's dragging Japan from a 20-year slump. However, a rise in VAT is expected to slow the economy in 2014. After an astonishing surge, the stock market is no longer cheap, but could have much further to run if Abenomics succeeds. Emerging markets, that diverse group led by Brazil, Russia, India and China, but including many other countries, gets a triple Santa. Emerging markets have been hit hard by the US Fed talking about tapering the amount of dollars it prints. If you believe in their potential, emerging markets look cheap, trading below their 10-year average. Bonds are the assets investors hold to smooth out the ups and downs of being in shares. Bond prices are falling as investors price in interest rate rises that will make their fixed interest payments look unattractive. The only really attractive area in bonds are high-yield bonds from companies that have to pay higher interest on their debt. Behind my Santa ratings is the idea of being underweight or overweight a particular market or asset. Professional investors talk about being overweight investments they like and underweight those they don't. Fund managers typically compare what they do in their funds to an appropriate stock market index. For our purposes, a balanced global index with a big UK component makes sense. See how shares outweigh bonds 4 to 1. International shares get 30%. If you use the index known as the FTSE World excluding UK as a guide, you'd put half of your international shares money into the US, but only a fifth of it in Europe. However, you might have good reasons to do something very different. Hopefully this has given you some things to think about as you review your investments. All it leaves me to do is wish you a Merry Christmas and hope you have a prosperous New Year.